Last week, I made a video that outlined a dividend portfolio a new investor might be interested in. It offered a market beating return over the past 10 years, nearly a 15% dividend growth rate, and would get you paid every week of the year. Even though the dividend yield of that portfolio was higher than that of the S&P, I know it left a lot to be desired for those kind of investors. So I decided to create this portfolio. Just like last week, this portfolio is going to feature 12 individual quarterly paying dividend stocks that all have a forward dividend yield above 2.5%, have a payout ratio under 71%, and consistently pay during the same 7-day period each month. In order to keep this portfolio diversified, I made sure there was no more than one stock per sector per month, and no more than 3 stocks in any one sector throughout the whole portfolio. I also didn't include any real estate stocks because of how those are taxed, and ideally, I think this portfolio is best held in a taxable account. And normally in my videos, I like to provide stocks that beat the market over a certain period of time, but I wasn't able to find 12 stocks that beat the market for this portfolio. Frequently with the higher yielding stocks, you're opting to take the money up front instead of the total returns on the back end. But with that out of the way, let's get to the list. So the payer for the first week of January, April, July, and October is United Bankshares, stock ticker UBSI, and they are in the financial sector and have been paying and growing their dividend for the past 48 years. United Bankshares has a forward dividend yield of 3.48%, a 5-year dividend growth rate of 1.61%, and a payout ratio of 48.98%. UBSI is currently paying $1.44 per share per year, and their next ex-dividend date is estimated to be on March 10th with an estimated payout date of April 1st. United Bankshares over the past 10 years has underperformed the S&P 500 by $8,702.29. Our payer for the second week of January, April, July, and October is Best Buy, stock ticker BBY, and they are in the consumer discretionary sector and have been paying and growing their dividend for the past 19 years. Best Buy has a forward dividend yield of 3.99%, a 5-year dividend growth rate of 20.95%, and a payout ratio of 48.75%. BBY is currently paying $3.52 per share per year, and their next ex-dividend date is estimated to be on March 23rd with an estimated payout date of April 14th. Best Buy, over the past 10 years, has outperformed the S&P 500 by $37,006.19. The next payer will be for the third week of January, April, July, and October, and that is Cardinal Health, stock ticker CAH, and they are in the healthcare sector and have been paying and growing their dividend for the past 28 years. Cardinal Health has a forward dividend yield of 2.52%, a 5-year dividend growth rate of 1.5%, and a payout ratio of 31.28%. CAH is currently paying $1.98 per share per year, and their next ex-dividend date is estimated to be on March 31st with an estimated payout date of April 15th. Cardinal Health, over the past 10 years, has underperformed the S&P 500 by $9,484.87. The payer for the final week of January, April, July, and October is Altria, stock ticker MO, and they are in the consumer staples sector and they have been paying and growing their dividend for the past 13 years. Altria has a forward dividend yield of 7.93%, a 5-year dividend growth rate of 7.7%, and a payout ratio of 70.98%. MO is currently paying out $3.76 per share per year, and their next ex-dividend date is estimated to be on March 24th with an estimated payout date of April 29th. Altria, over the past 10 years, has underperformed the S&P 500 by $8,005.90. So the pair for the first week of February, May, August, and November is Verizon, stock ticker VZ, and they are in the communication services sector and have been paying and growing their dividend over the last 19 years. Verizon has a forward dividend yield of 6.49%, a 5-year dividend growth rate of 2.07%, and a payout ratio of 50%. Verizon is currently paying $2.61 per share per year, and their next ex-dividend date is estimated to be on April 7th with an estimated payout date of May 2nd. Verizon, over the past 10 years, has underperformed the S&P 500 by $17,702.55. Our payer for the second week of February, May, August, and November is Cheniere Energy, stock ticker CQP, and they are in the energy sector and have been paying and growing their dividend for the past 6 years. CQP has a forward dividend yield of 6.37%, a 5-year dividend growth rate of 12.02%, and a payout ratio of 64.43%. CQP is currently paying $3.10 per share per year, and their next ex-dividend date is estimated to be on May 4th with an estimated payout date of May 13th. CQP, over the last 10 years, has outperformed the S&P 500 by $7,158.34. The next payer will be for the third week of February, May, August, and November, and that is ABBV, stock ticker ABBV, and they are in the healthcare sector and have been paying paying and growing their dividend over the last 11 years. ABBV has a forward dividend yield of 3.91%, a 5-year dividend growth rate of 17.12%, and a payout ratio of 41.41%. ABBV is currently paying out $5.92 per share per year, and their next ex-dividend date is estimated to be on April 12th, with an estimated payout date of May 15th. ABBV, over the past 10 years, has outperformed the S&P 500 by $27,570.08. The pair for the final week of February, May, August, and November is People's Bancorp, stock ticker PEBO, and they are in the financial sector, and they've been paying and growing their dividend for the past 8 years. PEBO has a forward dividend yield of 4.92%, a 5-year dividend growth rate of 12.3%, and a payout ratio of 41.87%. PEBO is currently paying out $1.52 per share per year, and their next ex-dividend date is estimated to be on May 3rd, with an estimated payout date of May 22nd. PEBO, over the past 10 years, has underperformed the S&P 500 by $9,653.30. So the pair for the first week of March, June, September, and December is Pfizer, stock ticker PFE, and they are in the healthcare sector and have been paying and growing their dividend over the past 13 years. Pfizer has a forward dividend yield of 3.8%, a 5-year dividend growth rate of 4.57%, and a payout ratio of 24.32%. Pfizer is currently paying out $1.64 per share per year, and their next ex-dividend date is estimated for May 20th, with an estimated payout date of June 4th. Pfizer, over the past 10 years, has underperformed the S&P 500 by $8,470.66. Our pair for the second week of March, June, September, and December is International Business Machines, stock ticker IBM, and they are in the technology sector and have been paying and growing their dividend for the past 28 years. IBM has a forward dividend yield of 4.89%, a 5-year dividend growth rate of 2.24%, and a payout ratio of 65.45%. IBM is currently paying out $6.60 per share per year, and their next ex-dividend date is estimated for May 27th, with a payout date of June 10th. IBM, over the past 10 years, has underperformed the S&P 500 by $21,502.91. This next pair will be for the third week of March, June, September, and December, and that is Manulife, stock ticker MFC, and they are in the financial sector and have been paying and growing their dividend for the past 9 years. MFC has a forward dividend yield of 5.04%, a 5-year dividend growth rate of 10.12%, and a payout ratio of 40.9%. MFC is currently paying $1.46 per share per year, and their next ex-dividend date is estimated to be on February 27th, with an estimated payout date of March 20th. MFC, over the past 10 years, has underperformed the S&P 500 by $12,634.98. The stock rounding out the list and the pair for the final week of March, June, September, and December is Devon Energy, stock ticker DVN, and they are in the energy sector and have been paying and growing their dividend for the past 6 years. DVN has a forward dividend yield of 6.68%, a 5-year dividend growth rate of 23.61%, and a payout ratio of 48.4%. DVN is currently paying out 80 cents per share per year, and their next ex-dividend date is set for March 14th, with a payout date of March 31st. DVN, over the past 10 years, has underperformed the S&P 500 by $20,201.44. Now, with all the numbers laid out, let's take a second to sum up this portfolio. The average dividend streak of this portfolio is 17.3 years. The average 5-year dividend growth rate is 9.65%. The average dividend yield of this portfolio is 5%. And the average payout ratio for the portfolio sits at 48.06%. And as mentioned in the beginning of the video, I didn't want to put too much weighting in any one sector. So here you can see how this portfolio balances out. And now that we know the stocks and about that impressive dividend yield, let's see if we can compete with the S&P 500 for total returns while chasing that passive income. So let's get this one set up over here on portfoliovisualizer.com. I went ahead and entered our time period from 2013 to 2023. I included year to date for the most up-to-date information. And here I wanted to just make the initial and recurring deposits obtainable for a majority of people. So I went with $1,200 as an initial investment back in 2013 with a continuous $1,200 for each of the following years, 2014 to 2023. Since inflation has been top of mind for the past few years, I went ahead and made this one inflation adjusted just to keep up with the times. I went ahead and make sure we're balancing this portfolio yearly, and I don't use or encourage leverage, so I left that off. And we're going to be reinvesting those dividends, and we want to see the income generated by the portfolio. I'm not sure what factor regression is, so I just left that one alone. And lastly, our benchmark is going to be VOO that tracks the S&P 500. Now that we're all set up, let's hop in the time machine and see how this portfolio would have done. So the intent of this portfolio, for simplicity's sake, is to put an even amount of money in each holding. So here you'll see that we have all 12 of the holdings evenly split up with 8.33% each, which gives us this pretty looking pie. As you heard earlier in the video, this portfolio is higher yielding, and that typically slows down the overall growth, which leads to some of these stocks doing way better than others over the past 10 years. I still wanted to keep it as fair as possible since we wouldn't have known which ones would have been the best of the bunch without the hindsight we have now, so I kept all the holdings even from the jump. The first thing we'll look at here are the annual returns since the inception of the portfolio. You'll see the getting paid weekly portfolio here with the blue bars and the S&P 500 with the red bars. For this portfolio, we were not able to beat the market each year as it only outperformed the S&P 500 in 4 of the 11 years you see here. But as we mentioned, the goal of this one is to get dividends and get them frequently, so beating the market is not top of mind for this kind of investor. Speaking of performance versus the S&P 500, let's see how close that battle ended up being after 10 years. Again, we had that initial balance of $1,200 for both portfolios, and over the course of the past 10 years, you can see that the getting paid weekly portfolio would have turned into $26,481, which does slightly outperform the S&P 500, which turned into $26,156 in the same time frame. This leads to a 35.91% compound annual growth rate for the getting paid weekly portfolio versus the 35.75% for the S&P. Next, let's look at the TWRR, which stands for the time-weighted returns, which you can see how both did here. But since we're adding more money, $1,200 every year, and the dividends are reinvested, it's better to use the MWRR, which stands for the money weighted returns, which again, the getting paid weekly portfolio won 11.82% to the 11.59% from the S&P. Now over here, you can see the best and worst years. Again, you can see that the best year from the getting paid weekly portfolio was 51.15% versus the 32.39% from the S&P. And the worst year for the getting paid weekly portfolio was down 9.65%, but that's versus the 18.19% the S&P 500 was down in its worst year. And the last column here that I can understand is the max drawdown. The max drawdown is just the furthest each portfolio fell from its peak. You can see that this portfolio did fall by a massive 27.67% at one point, which makes it more than the S&P's max fall of a still depressing 23.91%. This graphic does a good job of highlighting the good and bad times for both portfolios. Over the past 3 months and year to date in 2023, the S&P 500 would be the better option for overall returns. But the getting paid weekly portfolio really took the cake over the past 12 to 36 months in not only total returns, but also in that juicy dividend income. One of the last things I wanted to show you here is the performance of this account versus the S&P 500 in a chart that most of us can understand. The top chart is the overall growth, while the bottom one includes the inflation adjusted numbers that we requested in the beginning. Again, the S&P 500 is in red and the getting paid weekly portfolio is in blue, and you can see how close this one was pretty much the whole time. Now, the fact that I was able to make a portfolio that gets you paid every week, yields over 3 times that of the S&P 500, and actually outperform the market over the past 10 years is pretty cool. But that's not even the strong suit of this portfolio. So now let's see what those dividends look like for this portfolio over the past 10 years. So all these numbers are the yearly totals and dividends received. In 2013, we would have made $52. That moves to $100 in 2014. Then in 2015, we're up to $155, then $214 in 2016, and $281 in 2017. In 2018, that bumps up to $393, then up to $498 in 2019. Then we skip the 500s altogether and go straight to $635 in 2020. Followed by another jump to $894 in 2021, and finally we hit $1,255 in 2022. So far, in 2023, we would be up to $74 in just the month of January. Something I wanted to draw attention to here with this chart are the wonders of compounding those dividends and how it only amplifies the longer you give it. In the beginning of the episode, I set out to solve the issue of infrequent dividend payments. With this portfolio, over the course of 10 years, you would have turned your $12,000 into $26,481. You would have beat the S&P 500 over the course of the 10 years. You would have received 480 dividend checks, and you would be making over $1,464 in dividend income in 2023. Keep in mind, this is all only with $1,200 invested per year, which is $100 per month. If you can do more than that, you can just multiply these results even more. I didn't want to show you guys all these backwards looking numbers to show you how we missed the opportunity, but instead to show you that just because you like or need higher yielding portfolios, that doesn't mean you can't outperform the market and get paid every week while doing so. I really hope you guys all enjoyed today's content. If so, please be sure to leave a like on the video to help others find the channel, and subscribe and ring the bell so you don't miss any of my dividend related content. And use the comment section down below to let me know if this or a portfolio like this interests you enough for you to try it on your own. And if you missed it and happen to focus more on the dividend growth rates approach versus this dividend yield approach, make sure you check out this video I just posted last week But until next time, see ya.